Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
So, good morning, ladies and gentlemen. My name is Philipp Bunnenberg, and I'd like to welcome you to today's BAI webinar on real estate debt. So, for all of you who attend the BAI webinar for the first time, I would like to give a few instructions. We will make a recording of the webinar, so if you miss a part, you can rewatch it on our channel. We will also provide you with the speaker's slides after the webinar. All participants are muted and your video is turned off. So if you want to interact with our speakers, please feel free anytime to ask questions. So on the right-hand side of your screen, there should be the BAI GoToWebinar tool. So in this tool, you can click the button questions, or in German Fragen, and you can type your questions into the tool, and I will read it out loud, and the speakers would like to answer your questions in the Q&A session after the webinar. So first of all, I would like to take the opportunity and provide you with an update on our recent association's work. We already planned the next event in end of September, the first BAI Innovations Day. The day is all about technological developments in the asset management industry. We will focus on digitalization, DLT, and artificial intelligence. The registration to the event is already open, so just go on our homepage, on our website, and feel free to register. Recently, we wrote a letter to the Commission in the course of the ongoing CRR review. We have been in a constructive dialogue, and now we summarized and specified our arguments for an appropriate and differentiated risk weighting of investments into specific type of alternative investments under the CRR. And of course, we will make the paper public very soon. Furthermore, we have plenty of consultations ongoing. So first of all, as you may already know, the EU platform on sustainable finance has presented the draft taxonomy extension to support economic transition, and of course also the draft report on social taxonomy, and put both out for consultation. And on top of that, the technical working group is calling for feedback on preliminary recommendations on technical screening criteria for the remaining four environmental objectives which haven't been consulted yet. So plenty of consultations ongoing. Also in Germany, the BaFin is very active. We have the guideline for sustainable public investment assets, and the modification of the FAQ on the distribution and acquisition of investment funds under the KGB, which are adjustments as a result of the Fondsstandortgesetz and the directive on cross-border fund distribution implemented therein. So lots of work going on. There isn't really a summer break this year. And on top of that, we have two upcoming papers which will be published soon on infrastructure investments and on tail risk mitigation from COVID-19. So last but not least, we will start our yearly investor survey next week. And on top of that, for the first time, also a BAI member survey, sorry. I know that surveys are kind of annoying. It's what it is, but I would really appreciate it if you take your time, if you are contacted from us, because it's very important for our association's work, and the results are also important for German investors and of course for our member firms. And on top of that, it's also for a good cause. So if you participate, we will donate a fixed amount as last year to organizations for the good cause. This year it's Oxfam Deutschland, Tafel Deutschland, Deutsche Kinderkrebsstiftung and Flutopfer, Stiftung für die Flutopfer der letzten Hochwasserkatastrophe. So I would really appreciate it if you take your time, approximately 10 to 15 minutes, and participate in the service if you are contacted from us. So that's for now an update on our association's work. Now let's get back to today's webinar on real estate debt. I would like to welcome our two speakers today. First of all, Ralf Kind, Managing Director and Head of Real Estate Debt at Rothschild REIM in Frankfurt. He will provide us with a market overview and is going to give us an insight into the realization of investments via two case studies. Next, welcome Andreas Schäfer. He's Director Real Estate Debt at M&G Investments. And Mr. Schäfer, he will explain why real estate debt might be a preferred tool to maintain exposure to real estate in times of increased volatility and uncertainty, also, as I know, via two case studies. So let's start the webinar, and I like to hand over to Mr. Kind.
Philipp, thank you very much for your nice introduction. Good morning, everyone from Frankfurt. Pleasure having you on this call. So let me break down the 20 minutes that I have in a few components. So first of all, I'll give you an overview of the real estate debt market in Europe. I'm just trying to see how I navigate this thing here. Following on from that, touch upon the advantages of investing in real estate debt. And I'd like to give you a little bit of background information about a very important conceptual piece, which is the capital stack, which is important in order to understand the case studies, which I then followed on. So first of all, the market, and really the private real estate debt market in Europe basically started after the great financial crisis, so around 2010, 11-ish, and has emerged as one of the fastest growing markets in terms of investor allocations over the last few years. And why is that the case? To give you the answer, let's start first with the supply side and stating the obvious. Real estate is a very capital intensive business. We all know that, so debt has always played a very important role in funding acquisitions of portfolios. Now, regulatory capital requirements, however, so Basel III, Basel IV, all the things that BaFin is publishing, have forced the traditional lenders, so the banks, to actually reduce their exposure to real estate and or to focus on lower leverage transactions. And I would also say that banks have become, not just because of COVID, but it was sort of accelerated by that, very selective and conservative when they underwrite loans. And I think from my personal observation, it's a less factor of the real estate. The real estate is okay or good, but many of the bank's balance sheets are simply impaired, and they don't have the capacity to actually do it. If we then move on to the demand side, so borrowers on the other hand, they are looking for flexible and reliable capital, and quite often also need a little bit more leverage than just the 50 to 60% that they're getting from the banks. And this supply-demand imbalance really created a funding gap that private real estate debt funds like ours or the one from M&G exploiting. In terms of deal flow, we see a lot of transactions in the market, and let's not forget in debt we have two main sources of deal opportunities. On the one hand side, if a investor is buying a new building, he needs a loan, so that's acquisition related financing. But on the other hand, there is the refinancing of maturing loans. So a typical term of a loan is 3 to 5 years. So every year, roughly, I would say you have more than 100 billion of loans coming due in Europe, which need to be refinanced. So in other words, there's a very steady and healthy deal pipeline, even if the investment activities are a little bit lower, for instance, last year, given the lockdown situations. Now let's touch upon COVID and how this all impacted real estate debt. And I would say that Corona and the pandemic crisis really expedited the structural change that I mentioned before. So banks accelerate to actually withdraw from the markets. Clearly, they're still there. If it's a core product and it's a simple loan, then you get plenty of term sheets from banks. But if it's a more value-add transaction, or maybe in a secondary location, then it is it's become very difficult for borrowers to find debt from the banks. On the other hand, you have the investors. There's a huge investor demand for real estate debt because in terms of crisis, obviously credit is a safer place to be, and people appreciate stable income and a security package when markets are going through a correction like we had with Corona. In a nutshell, I think that real estate debt has been a net beneficiary of the Corona crisis. So even the title of my presentation says it's a winner, one of the winners of COVID, because we're now in a lender's market, which means that as a lender, you can charge higher margins, so better pricing at the same risk, or even at lower risk. And I believe that this year and next year will be excellent vintages to do very good debt investments. Now, if we move on to the next slide, maybe Roland, you can navigate that for me. Thank you very much. So let's look at and try to no, the previous one, please. One slide back. Exactly. Thank you very much. So why is private real estate debt a very interesting asset class, and a lot of money is pouring into this asset allocation? Because I think, quite frankly, it is giving investors what they want, and this is an attractive risk return with a high income component, so stable income from the loan margins. Then, secondly, I would say it's definitely a diversification away from a lot of equity investments in real estate that many institutional investors have. So it's a good diversification play. Then there is downside risk protection. If you provide a loan at 70 or 75% loan to value, there's still 25 risk cushion behind you, which is the equity risk. And on top, you benefit from a security package. And as mentioned before, if we're going through wobbly times and a volatile market, then this is actually a quite interesting proposition for many investors. And also, that's the second point from the bottom, low correlation to other asset classes. I mean, it's private real estate debt. It's not traded. There is not any real market volatility that you need to reflect in your NAV or accounting statements. In fact, most of the debt funds that I know, including our own, is operating under the amortized cost method. So there is no mark-to-market necessity. And the last point, if you as a listener to this webinar, if you're an insurance company, that's your particular point. There's a very favorable regulatory treatment under Solvency II. We all know that Solvency II benefits debt over equity investments. So the SCR, solvency capital ratios for debt investments are much lower than for equity investments. And the last point on the slide is, if you look to the left, where you have this map of Europe, the message here, it's a very big market. The numbers that we're showing here are a little bit outdated. I would say they're 2 years old. Probably they're bigger now. The market is more than $1 trillion of commercial real estate loans in Europe, and the majority thereof, I would say, still sits on the balance sheets of banks, but their share is reducing, as mentioned before, which means that the share of alternative lenders is growing exponentially. And I would say it's a very strong growth market. And you can also see that when you read the newspaper, there's also a bit of M&A activity going on, that some of the big firms are buying debt fund platforms, or you have new fund managers setting up real estate lending programs in Europe. So it's a growth market that is benefiting from a structural change that will not go away over the next few years. If we move on to the next slide. Thank you. There's a very good analysis which is being published annually by INREF. So this is the data is from INREF that you see on this slide. This gives you an overview of the active private real estate debt funds in Europe. If you look at the top right-hand corner with the pie chart, there are 80 funds operating according to INREF, and more than 50% are still pursuing senior lending strategies. Typically, senior lending strategies, they have an IRR target of, let's say, 3 to 4%. And then you see that with the other color codes, that there are different other funds. Some are just focusing on junior debt. Some are doing the entire capital structure, like our own fund. So it's evolving, and the share of the senior lending strategies is decreasing over time. Initially, it was a lot of senior lending strategies in Europe. Bottom right-hand side, most funds are pursuing a multi-sector strategy, which means they're not just focusing on office or residential, but they are sector agnostic, so they can do anything from office, retail, resi, all the way to niche sectors like student living and so forth. In terms of geographies, on the left-hand side at the bottom, it's a little bit complicated how this is shown here, but the message is that the majority of the funds still pursue a single country investment strategy. So they focus, for instance, just on Germany, or maybe they add in Austria because it's German speaking, or the DACH region, or you have UK funds that are just pursuing deals in UK. And if you look at those, the majority of the funds that are pursuing single country strategies are in fact in the UK. You see that on the left-hand side, which means that players who are active across Europe, truly across Europe, like the two you have on this webinar today, it's, I would say, still the minority. Last point on this slide, maybe on the returns. I mentioned the average return on senior lending strategies around 3 to 4 lender IRR. Third bullet point on the left-hand side, according to INREF, the median IRR of all those funds in the sample, and that's target return, not realized, is close to 8%. And if we go to the next slide, please. Thanks. Before we come to my two case studies, I wanted to take the opportunity to define a few terms and make sure that we are all on the same page. There's the concept of real estate capital stack, which you see on the left-hand side. These are the different layers of funding or financing that flow into a debt transaction. It's important to understand where you sit in this capital stack, because it determines the order of priority in terms of cash flows and your security position, ultimately the risk. So at the bottom, you see in dark blue, 55% LTV. That's just an example. A typical senior mortgage loan, first ranking position. This is what you get from a traditional bank. If you add a little bit more leverage, which is in the light blue, which is a junior mortgage debt, some people say it's stretched senior. And if you combine the light blue and the dark blue in one loan facility, it's called whole loan. And that's actually a very interesting product. A lot of borrowers are asking for that because you avoid talking to two capital providers, a bank on the one hand side with a senior loan and then a debt fund with a junior piece on the other hand. You combine it in one loan agreement, you're faster, and speed in execution is always key when you want to make a deal. On top of that, you have mezzanine, which is in orange or red here. This is then further subordinated. Here, typically, you talk about 8, 10, 12% return, depending on where you are. And above that, then in green is the equity world. If you're an equity investor, you are typically buying the first loss position. So you're in the highest risk position if you invest in equity real estate. Investing in private real estate debt, however, is not just a financial analysis. It's very much, and I'm a firm believer that the key point for the analysis of any deal is the real estate. So on the right-hand side, you see a few pictures of deals that we've done or currently are doing. They have different risk profiles from more core plus to value add. And obviously, it's very key when you go into a deal that you understand that, because this is where your cash flow is coming from, that is flowing through this capital stack or waterfall and ultimately determines the value. Now, with having said all this, we're ready for the case studies, I think. If we move to the next slide, please. So if we translate that into practice, what does it mean? The first case study is a deal that we've done in late June, which is a mezzanine loan subordinated in an acquisition context. We provided close to 20 million to a sponsor named Aventos. Aventos is led by Professor Stefan Bonewinkel. If you're German, you're probably familiar with this name. He ran BEOS in the past, then sold it to Swiss Life and founded Aventos. He and his partners, they bought a large mixed-use asset in Berlin. It's a sale and leaseback transaction with Osram. Osram leased back about 80,000 square meter of office, and then you have more than 150,000 of development space. Ultimately, it will be developed into a mixed urban commercial area in Berlin. It is situated close to the Siemensstadt in Spandau. Interestingly, we negotiated a term sheet. You see that on one of the bullet points on the left-hand side around mid-May, and we funded the transaction by the end of June. So effectively, we had 6 weeks to do the underwriting and the approval process. We, as Edmond de Rothschild, we have real estate people on the ground in each country in Europe, also, of course, in Germany. So with our real estate people, we've inspected the assets, we've done the site visits, and provided a loan. And as a mezzanine, we're subordinated to the senior lender. Senior lender is the HASPA, so the Hamburger Sparkasse. And maybe the last few words on this case study is on the right-hand side bottom. You see a few numbers. So the loan has a maturity of up to 5 years. Embedded are some extension options. The LTV is around 75% loan to value, and we have an IRR of a double-digit IRR of more than 11%, with a cash coupon of more than 4%, which is guaranteed and backed up by an interest reserve account. So the money is in a locked account to pay the interest. If we then move on to the second case study. Yes, thank you. That's a different loan. That's this time it's a whole loan. So you remember the slide with the capital stack. Whole loan means senior position, but a bit more leverage. So we have a first ranking lend charge with all the bells and whistles on the security package. The collateral are 2 office buildings in Amsterdam in an upcoming office market called Sloterdijk. The asset itself is 15 minutes away by car from our office in Amsterdam. Again, our own property guys have, together with the team here, inspected the asset. The investor in that deal is Angela Gordon, I think a well-known private equity fund, together with a local operating partner called APF. They have done, I think, about 10 deals of similar nature in the past. So it's a good team with a lot of track record. And here we provided 55 million over a 4-year period. It's basically 2 tranches. One is an acquisition tranche to refinance the buildings. By the way, Angela Gordon bought it all equity a year ago or so, and then we refinanced the equity. So that's one tranche, and the other tranche is a capex facility. One of the buildings is capex heavy business case, so there's a lot of activities. They basically tear it down and rebuild it, and the other one is a more capex light program. A few statistics, bottom right hand side. So 4-year term, 55 million whole loan. We've done it under Dutch law, by the way, which was also a good approach. I think it speeded up the process. Close to 70% loan to value, and here we are at an IRR of north of 6% with a cash coupon of around 4%, which is backed up by a sponsor guarantee from Angela Gordon. If we then, I think my time is also up. If we go to the last slide, Roland, just to finish it up. So you have another picture of me and the team. My team is here based in Frankfurt. You see my contact details. If you want to reach out to me, just drop me an email. So thank you very much, and I'll hand over to you, Philipp.
Thank you very much, Ralf. There are already a few questions incoming. I would suggest that I still collect them and hand over first to Andreas, and then we make the Q&A session afterwards. If it's okay for you, Andreas, if you're ready, you may start.
That works for me.
Great.
Okay. Thanks, Ralf. I think that was a great introduction to the asset class as a whole, and there'll be a lot of hopefully touching points in my presentation that build on what you just said. What I'm intending to do is basically put the asset class into today's context. So we're looking at a market where some of the traditional real estate fundamentals and the way of thinking don't hold anymore. And one of the reasons why we as a house really like real estate debt is because of some of the tools that are built into the asset class as a private asset instrument that allow you to access real estate in times of high market volatility. You can basically, given that it is a debt instrument, when things are in flux, you can position yourself in a way to still achieve attractive risk-adjusted returns, even if the overall markets don't perform as was previously the case. As Ralf mentioned, we are now in the lender's market. What that means in the context of a private debt instrument like real estate debt is for houses like Ralf's and ours who originate loans directly. You really have the opportunity to impose on the borrower conditions that bite in certain circumstances. So working with covenants, for example, that mean if things don't go as planned, you have a lot of input on what you can do with an asset as a lender can be very important. Generally, because of the structuring approach, having dedicated real estate debt experience, specific real estate debt experience as opposed to just real estate experience, for example, is a key consideration for investors who, for example, are giving us money. And really the point of, because it is a debt instrument, making sure you protect and preserve your capital has to come first. And then in the second instance, you then look at ways to access interesting returns. Because of the cyclical element, which is also playing a role in the real estate debt markets, things like high quality structuring, covenants structuring, protections for lenders tend to erode over time. But as mentioned previously, we're now back in a position where the pendulum is swinging the other way, and really the loans you originate today can be of a much higher quality, as might have previously been the case where market pressures have led some lenders in the market to really drop their guard and forego things like covenant structures, interest rate reserves, and the like. So what I'm going to do in the presentation is just give you a very quick overview of how we see the real estate markets today, what returns we see on the real estate debt side, and then just give a couple of examples on the structuring, and lastly, just some closing remarks on for investors in the strategy who are thinking to pick a money manager, what are some of the considerations are that we see. Looking at this slide, so we're just looking across asset classes. So basically at the top, what's currently considered to be the safest part of the spectrum, and moving down to the higher risk of the spectrum, and how that interplayed with COVID and general consideration. So on the logistics and residential and long income side, certainly on the real estate equity side, people still love the asset class, and there's huge amounts in terms of weight of capital. And similarly, on the lending side, you will find the most aggressive terms in terms of leverage as well as pricing. Now, from a structuring side and accessing the asset class, you will have to look at fairly low debt yields and as a consequence, for example, interest rate exposure. So picking the right leverage point and also creating structures where you force the borrower to really create the reversion that they're building into their business plan is a key consideration for the lenders to make sure your value doesn't erode over time. On the office side, again, there's a structural shift which is leading to a bifurcation of real estate. So office that's being left behind because it's BC quality and doesn't fit today's tenant demands. On COVID here, obviously the change in working habits has further accelerated that shift. And on the lender side, again, you may want to, one, reduce your basis and say, I think there's a correction coming in office values, and you, rather than wanting to be in the equity, you may prefer the debt. And similarly, for example, if you finance office construction loans, you can really earn some interesting returns while being left at the end with a brand new building that will be up to market standard. On the student housing side, most markets across Europe are still fundamentally undersupplied. As a lender, we very much think of this as an operating asset class. So understanding the market fundamentals, picking the right borrower and operator and the asset in the right location are key considerations. And then on the loan structuring side, having a loan structure that isn't just based on a simple income covenant and an LTV covenant is quite key, because you need to, for example, take into consideration that there is a booking cycle in the student housing sector that you can't miss, and you need to work with cyclicality reserves to make sure there's appropriate income to service your interest and amortization payments as they come due. On the hotel side, obviously a market that's been very much impacted by COVID. Here again, questions, for example, around what working from home is going to do to the sector. We think there's some interesting return opportunities over time, and especially within the sector itself. Again, there's a bifurcation. We think mostly business and conference-driven hotels will probably take a longer time to recover, whereas there's some interesting returns to be had in domestic leisure travel assets. And you can position yourself as a lender in that regard, again, because these are operating assets which previously really weren't flavor of the month for lenders or for operators. That you need specialist knowledge really, and you need on the loan structuring side somebody who understands how these things work and what some of the protections are that that you need in order to make sure you get your money back at maturity. And then the most distressed part, probably certainly for us in the UK, is the retail sector due to the accelerated shift to online. Retail warehousing, grocery retail will continue to perform very well, but if we're thinking about shopping centers, for example, there's a very thin group of lenders who are looking at the sector, which, you know, even if you look back 6 months, there probably weren't any to begin with, and that's certainly reflected also in the returns that are to be had on the lending side as well. Just some of the returns as we see them based on the pipeline. So we're active across all major European markets. This is split by Northern Europe, UK, and Southern Europe, and then within that split by risk profile and senior and junior loans. So if we start Northern Europe, traditionally has been the most aggressively priced market on the lending side due to the prevalence of German banks, which have very low cost of funding. And really, if you start at the core sector, these are discount margins. So because real estate debt is a private instrument, you don't typically just earn your coupon. You also, for example, earn other fee components, such as an upfront fee that's due at origination. The other thing that distinguishes it, certainly in the current market environment from some of the public markets, is that Euribor floors are very common. So if you compare the spread you earn on a senior loan to a public market instrument, we like to factor in the benefit of the upfront fee, for example, and the benefit of a Euribor floor, which is reflected in these discount margins that you see, which are effectively adjusted spreads. So moving from something like 175 over Euribor for the core end in Northern Europe to up to 5% for development loans in Northern Europe, depending on where it is, what is your leverage. And then for the junior loans, you're really starting at 6% IRR and then moving across the spectrum up to 13%. We think the UK remains a very interesting market in terms of returns that we had, given the large amount of high quality stock that's available in the market. So spreads tend to be on average just a little bit higher than in Northern Europe, also because a number of fund brief lenders aren't as active in the market. But if you think about London and certainly on the letting side, for example, in offices, there's the fundamentals remain strong even in the face of COVID, and have been helped by the quick rollout of the vaccination program. And then lastly, returns available in Southern Europe, which are at the highest end, and again present a premium to the two aforementioned, where you can earn fairly interesting returns in the core sector. There are some core markets which Ralf also alluded to, so Madrid, Milan, being at the forefront of these, Lisbon today, giving you access to very good quality stock with good long-term returns, but on the lending side offering a little bit extra in terms of return. And then the development lender landscape is certainly very thin, leading to additional spreads. Now, these are everything here on the slide is sort of our middle of the road view. There certainly will be outliers to either side in terms of return. So we do think the risk-adjusted return, especially when we're thinking, for example, about publicly traded alternatives, be it in the CMBS sector or in the bond market, the asset class certainly remains very interesting in terms of returns that are available today. When we are thinking about the opportunity set and how we invest, Ralf kindly alluded to a number of these, and this is just breaking the risk parameters down again. It's really, it all starts, as Ralf mentioned, with the analysis of the real estate. And, when you're thinking about picking a manager, potentially, you should really pick somebody who understands how real estate works, because with poor quality real estate, even the best amount of structuring won't necessarily save you. Now, these are just, you can basically pick the type of investment you want to make on a spectrum that's presented by these different factors. So going from capital structure, where do you want to position yourself? Do you want to be super safe, or something more that's something more towards equity-like returns? You can pick a part of the spectrum here. Asset quality will be key. So you may have a view that you're happy with senior lending in the value add spectrum, because you can access basically fixer-upper type stories at low leverage with good quality sponsorship and earn an extra return. Then on the loan type, we distinguish between pure investment loans, pure income producing loans, or are you happy with something that requires a little bit of capex, a little bit of love, or are you even happy with full development, which is certainly the thinnest part of the market? It's very much specialized knowledge being required both on the lender side and on the borrower side. And hence, the risk-adjusted returns in this part of the market can be very attractive. For example, when referring to offices and building best-in-class offices in large scale, where there's only a handful of lenders available in some jurisdictions with high demand for new grade A space. Jurisdiction is a very key assumption for us as lenders. There are lender-friendly jurisdictions, which, if you think about the Netherlands, the UK, then there's a spectrum, and then there are more borrower-friendly jurisdictions. If you think, for example, of Italy or France, and knowing how to operate within that and what that means for your recovery analysis as a lender, and how to get your money back if the borrower decides to give you back the keys to an asset is crucial. And then lastly, on the origination side, you can access the market either directly, so you have a direct relationship with the borrower, and you sit down with the borrower and draw up a lending agreement and lend directly, or you can buy secondary loans from a bank who's originating for you. We very much like the direct lending approach, because that means all these requirements we have to structure and how all the risks that we're thinking about are reflected in a loan contract can be negotiated by us ourselves. So the quality can be higher, and you have you also can have better market coverage and better pricing if you originate directly. Lastly, on the slide also is that the sponsor quality can also be crucial. Sponsor quality isn't everything. So as lender, you will, for example, some houses are happy to, because they have the capability in house to take the asset over and maximize value and sell out of it, and that can be a great way to preserve capital or even enhance capital. For other lenders who are at the lower end of the spectrum, you may just be happy to sit there and let the sponsor do its thing. And again, that's a choice you have. The toolbox we're working with so consists of, on the structuring side, of loan covenants, security, and other. And I'm just going to walk through these very quickly. The loan covenants is really something you put into your loan agreement to say if certain things happen or don't happen, the lenders get certain rights. And as such, we're thinking of them as early warning signs or stop loss triggers. So for example, if the value of a property drops by a certain amount or the income drops by a certain amount, I as a lender either want to be paid down a certain amount or I want to be able to take over the asset. Leading up to full defaults, as we call them, are we may structure in some cash trap triggers. So if any of the levels are breached, we're basically taking all the excess cash flow of the asset, putting it on account for a rainy day, and in case of emergency, we can pay ourselves down. The key bit here is that how these things are defined, because two people will always think of a definition in two different ways. And my word of advice is loan to value as a metric, which everybody likes to look at, is very useful, but it can mean a million different things. So for example, on a construction loan, you may find somebody is effectively lending 95% of the cost of a construction project, including land, but the value they're quoting to you may be 70% or 75% loan to value based on the expected finished value of the property, which hasn't even materialized yet. And there's a question, do you actually get to that value? So that's a key bit. On the security side, which is a more technical part, so I'll just brush over that. You have senior mortgages and you have share pledges. You get pledges over accounts. And some lenders will take a more lax view on which of these you need. And in case of a default, which will make recovery for the lender more difficult. Lastly, there are things like funding sequence. So does the equity put the money in first? Does the debt put the money in first? Do they put it in at the same time? That can be crucial. Who gets their money back out first? So if you get some sales from the portfolio, how much does the borrower take? How much do you take? Then there are return considerations. ESG is a very big topic for all lenders, and you can structure some covenants, for example, also to go with this, or margin incentives, and lastly, prepayment fees. For junior loans, there will also be intercreditor considerations that you'll have to factor in. So what's the contractual relationship like vis-a-vis the senior bank who's sitting ahead of you and has first dips on the asset? So just two very quick examples of how you structure a loan in an okay way and then in a more firm way. So for example, here we're looking at a hotel whole loan secured against a four-star hotel portfolio in Italy on a franchise agreement at 60% LTV. So you can just say, okay, on the covenant side, I'm just having a loan to value covenant and an ICR covenant. But really, especially in a market environment like today, where there's a recovery story in the assets, you probably want to structure it a bit more tightly. So you may have EBITDA hurdles that the asset needs to reach over time, and that step up over time to reflect the recovery in the market. What we've seen a lot, for example, is that on the lease side, leased hotels that operators have don't have any substance. So you really need to understand the asset and how the P&L of this asset works, and you need to get into the detail. And that needs to be reflected in some of the covenants. on the LTV side, because it is an operating asset, may just not be your loan amount being the only liability. In Italy, for example, employer liabilities can sit in the structure as well, and they should be factored into your loan to value covenant, so you actually know what the true indebtedness is of the asset. On the security side, because this would be Italy, if you just have local Italian security, so first ranking mortgage and a propco share pledge, you probably want something outside of Italy in a more lender friendly jurisdiction like Luxembourg, like the Netherlands, which really allows you as a lender to go in there and take over the asset if you have to in a timely fashion. And then lastly, on other structural enhancements, you know, because interest cover on hotels will be quite low at the moment, you know, some of the, you may have an accrual feature and you may have a capex obligation to spend money on the asset on the borrower. What you really want to do if you think the asset needs capex is make sure that money is sitting on account as opposed to just being reliant on a promise from the borrower to spend money further down the line, to make sure what you think the asset needs can actually be delivered. And similarly, you may say, okay, my interest, as in the example that Ralf mentioned earlier, is actually sitting on an account, so that interest is actually there to pay myself current. There's a similar story on an office portfolio, which in the interest of time, I think I'm going to skip. It's basically more of the same in that, you know, look at what does a loan to value covenant actually include? How do parties define it? Does it give a true representation of the indebtedness of the building? And you may think about other targets such as ESG targets for new buildings. So if you're doing a construction financing, you can put that as a target into your loan agreement to make sure you actually get the outcome you want over time. And then on the security side, make sure if you do need to take over the asset, you have an appropriate structure to do this. Similarly, there are other considerations you can deal with. Lastly, for potential investors in the strategy, when they're thinking about portfolio constructions, this is sort of a personal point of mine. What we always get is that, or what we often get is that investors try to narrowly define what the mandate does, which, you know, is absolutely fine. The thing we then always point out is that they can have adverse effects that you may not think about in the first instance. So, for example, if you say you as an investor want discretion over the investments your manager can make, that you need to be set up, because this is a private debt market, to react fairly quickly, because otherwise, if your approval processes internally aren't in line with what the market does, you'll just end up losing deals and you're not going to deploy any capital. Similarly, maximum LTVs, this comes back to the point, how is LTV defined? Higher LTVs doesn't, you know, or lower LTVs can just mean that the metric is gained. Minimum maximum investment size is the same. If you say you want a minimum debt yield, for example, that can just lead to worse assets being selected as loan collateral, because somebody's saying they're just investing in high yielding asset classes, which will be worse. And all of these things affect basically your investment speed and the speed of repayment as well as the asset selection. And that would be the end of it for me. Always happy to take questions.
Thank you very much, Andreas. I think both presentations have been excellent compliments to each other and very informative so far. And we got a lot of questions, so let's directly head into the Q&A session. The first question from the audience is, I would say, a general knowledge question. I think both of you can answer. So maybe you can elaborate on a senior lending strategy and what is the difference between senior and junior lending strategy?
Andreas, do you want to do this? Because I'm only doing high yield stuff.
Okay, so on the senior lending strategies will be lower risk, lower return is the easiest way to think about it, and the important part about Senior lending is that the senior lenders will always get their money back first before any other creditors in the structure and before the equity. A junior lending strategy will typically be subordinated in terms of their claims to a senior lender. So there's a sequence of repayment. Senior lenders get their money back first, and then the junior lenders, and then the equity.
Thanks, Andreas.
Maybe just to add on this, important also in context of answering this question is the competitive environment. Banks provide senior loans. So if you are pursuing a senior lending strategy, you're competing against many players in the market. So in terms of deployment and origination, you got to be careful because there are many banks still around who love to do 50% loans on particularly good assets.
Thanks. Maybe we can continue with you, Ralf. I think in the beginning you mentioned that you use amortized costs for reporting and balance sheet. And the question is, however, do you calculate market values through DCF valuation methods for internal or maybe any reporting purposes?
Well, we need to distinguish between the asset, the collateral, so the real estate, and the loan itself. For the asset, so the collateral, of course, there is an ongoing valuation process, and you monitor it very closely how the value of the asset evolves over time. When we go to the loan side, however, you monitor that too, but you do not do a mark-to-market. What you do every quarter, or whenever your check is on the risk management side, you check if the loan is impaired or is there any risk of impairment. And if everything is according to plan, so the financial covenants are complied with, it's performing, there's no need to change anything because something else has happened in the market. Of course, if you run into a problem with the loan, then you need to take a closer look and maybe get also an external view as to how big the impairment potential is. And in worst case, you need to write it down.
Thanks, Ralf. So I see another question. I think it's for Andreas. I think you mentioned a bad boy guarantee in one of your case studies. Can you please elaborate? What is a bad boy guarantee?
It's so they're a concept, a lender tool that borrowers really hate and lenders really love. They're a lot more common in the US than they're here. Basically, it can mean anything, but if the borrower commits certain defined bad acts, it means that the loan switches from being a non-recourse instrument. So you basically, the only recourse you have as a lender is to the asset itself, to the borrower or the sponsor, more specifically, becoming liable for a certain amount. So let's say if there is an element of fraud, for example, you may, rather than just having recourse to the asset, you may get a pay down from the sponsor itself via the bad boy guarantee. It's always very narrowly defined in the guarantee itself, but it can be useful concept. But again, borrowers very much resist it. So it depends if you, for example, go to some of the very large borrowers, they'll categorically say, we don't accept this. If you work with smaller borrower and the dynamics of negotiation are more in the lender favor, you may actually be able to get something like this.
Thanks. So no more questions, I think. So once again, thank you very much, Ralf and Andreas, for your contribution today. And thanks for tuning in. I hope to welcome you again very soon at one of our BAI events, maybe even in September on our Innovation Day. So have a nice day. Enjoy your time.
Lovely.
Bye.
Thank you. Have a good day, everybody.